Whatever your usage of trend is, you to boost it up a little bit. Why? Because there is a bias in the use of trend line for whatever reason, but they can actually prove to be more extremely effective in your trading strategy. So there is absolutely no reason to avoid the use of trend line. You should use them more often in the course of your trading. This is Soji and you are welcome to Soji Forex. In this video, we want to look at trend line fake out. In trading trend line, there are basically three scenarios in a trend line. The first scenario is trend line breakout. The second scenario is reversal, while the third scenario is fake out. Our major focus in this video is on fake out. How do we avoid trend line fake out? In order to avoid the loss of money while we are trading. So what is the use of trend line? The trend line helps us to identify the major direction of the market. And for us to have an effective trend line, we need to connect 2 points together. And what is the point? We need a high and a low to be able to connect together. In a downtrend, for us to connect, we need a high and we need a lower high to connect a trend line. So it simply means we need 2 points for us to be able to connect our trend line. And if this is our point, if this is our first area, this, and this. So we need 2 of these points for us to be able to connect our trend line. This is a high and this is a lower high. So what do? We can easily pick up our trend line and connect it. This is our trend line. So you see beautifully, we have our point, we have this, and then we have these 2 points connect together. So this is how to arrive or how to draw our trend line. And for an uptrend, we will need a low and a higher low for us to connect our uptrend. We need a low and a higher low. And what that implies is, if this is our uptrend, for instance, we need this low and this low. So we'll pick up our trend line now. and we connect these 2 points together. So this is how to connect our trend line. So in this video, let's look at the major three scenario in trend line. The first scenario, which is our breakout, is what happened in this zone. So breakout is when price no longer respect the trend line as support or resistance level. As you can see, in a downtrend, the trend line serves as a dynamic resistance because price is moving towards the upside. So whenever price hits the trend line, it reverses back to the downside. So the trend line in a downtrend is serving as our resistance, while in an uptrend, the trend line, just as we are seeing in this scenario here, the trend line we are having in an uptrend is serving as our support. So we say a breakout is when the price, just as this price you are seeing now, price has been respecting the trend line. It couldn't break, did not go out of the trend line. So breakout is when price no longer respect the trend line as support or as resistance through its level. And you can see what happened at this zone. In this scenario here, price came to our trend line and did not respect it. What happened? Price break through the trend line and went to the upside. The number two is reversal. When trading a trend line, the second scenario is reversal. A reversal is when price continue to respect the trend line as support and resistance, bouncing from one level. Just as in this scenario, price came what we are having in this scenario is now price came all the way from here, pull back to this trend line and bounce on the trend line as a resistance and return back to give us another lower low. Okay, because here is our first lower low, here we have a lower high, and then price returns to give us a new lower low. So this is a reversal because price keep respecting the trend line. Then the third scenario is fake out. Fake out. So I'm trying to get a typical example of a fake out situation of a trend line. Now in this scenario, we are having a typical fake out. Okay, now we have our high, we have this first high, we have this second high, this is our lower high, we have our lower low, we have another lower high, a lower low, a lower high, and a lower low. Now at this point, you can see that price pulls back to the trend line, and gave us this bearish candlestick pattern. But look at what happened. Price break out of this particular trend line, and looking at the breakout of this price, you can easily assume that price is moving to the upside, and then suddenly the price returns back inside. So this is a typical scenario of a fake out. So a fake out is when price break out of the trend line, manipulating traders to go a long direction, that is in a downtrend, and reverses back to continue in its original direction. And this is what I mean by this scenario. Now this is a trend line, and market begins to move this way. Price keep moving in this direction, giving us higher high, lower low, higher high, lower low, higher low, I beg your pardon, higher high, and then so in this scenario, you are expecting this price to give a new price to give us a new higher low here, and then suddenly this price break out of this trend line. See, the price break out of this trend line here, now with the intention that price will continue going bearish, only for price to return back inside the trend and continue making another higher high, higher low. So what is responsible for this fake out is liquidity. Liquidity is responsible for fake out. And why? What are we talking about? What we simply mean is that most of the scenario when we are taking trades on our trend line, we usually place a trade when price pull backs to the trend line and give us a candlestick pattern. We make our entry and we put our stop loss below the candlestick pattern, below the trend line. So the market, smart money players will always come, sweep the liquidity, and then continue to move in that direction of the market. So the drives, the cause of fake out is liquidity. So price will always pull out, sweep the liquidity, and then continue in that direction. Then how do we take advantage of this scenario? If this has happened to you, drop it in the comment section. Now, how do we avoid this particular scenario? The truth is, this scenario cannot be completely avoided, but we can take advantage of this scenario, because whenever such pattern has happened, it becomes a potential zone for trade continuation. So this particular candle that takes away this liquidity becomes your focus, because for every liquidity it means there is still a trade order hanging at this zone. And this is what the scenario I'm trying to explain, that there is a candle that break out here that take away this liquidity. So the smart money players still have an order left behind here. So all you need to do is for you to highlight this zone, because price is going to come back inside the zone for them to close this their order. Then you begin to look for any form of imbalance, or this candle, the open of this candle, there is no imbalance, or 50% of the range for you to buy to the upside. So this zone becomes your potential zone, and 80% most of the time this plays out very, very effective. Now, another way to notice this particular fake out is the speed in which price used to break the zone. The speed with which price used to approach your trend line and as well as break through your trend line should communicate something to you that actually this is a fake out. And what I'm trying to say in essence is, because their goal is to sweep your liquidity, they will move with speed. They begin to move with speed. For example, let's look at what happens here. We have been in a downtrend, right? Lower low, lower high, lower low. And now this is a 4-hour candle. Look at the previous lower low. Let's examine it. You see that market was moving slowly. Look at the candle with some wick, slowly. Then we have a hanging man, which gave us a bearish reversal candlestick pattern, right? And then here again a hanging man, an inverted hammer, and then you can see this scenario. Now let's move back to see another typical scenario. This, you can see how price was going gently. Here you can see how price was moving to the zone. You can see it gently before the reversal. Now let's look at this scenario. Can you see the force with which price moves? With speed, the strength, the volume, and then when it reaches this zone, it has to play around, because when it gets to this zone, it has to give hope so that people can sell for them to take the liquidity. And when they put this sell, immediately after this candle, more people will enter more sell, because they would have confirmed to say, yes, the market is already selling, let us enter, and then they place more of their sell trade. And eventually, immediately after those trades, price break out of it, took them out, fake them out of this zone, and move to the upside. So this is a typical fake out scenario. You see this pressure, and most of the time, and that's why I say, once you have this fake out, what you need to do is for you to mark out the order block that triggers this fake out. And this is the order block that triggered the fake out. Now this particular order block triggered this fake out. And once you have this scenario, what do? Marking the candle that triggered this fake out, you already know that most of the time price will now pull back and change direction. Because most of the time this fake out is what will take this liquidity of this zone. You can see that this liquidity of this upside has already been taken, which now shows that there is a break of structure. So most often the fake out of the trend line result into a break of structure and the overall reversal of the market. Then you mark out your zone, you put your Fibonacci level to the previous level that it has made, which is this, and then price pull back to 61.8 zone. I remember I said you look forward for these things. Now 61.8 zone, you go to your lower time frame and find either a double bottom or a break of structure, and you join this move to the downside. Anything from 50% down, you find your entry, or you wait for price to fill this imbalance. Maybe later in the future price will still need to come back to fill up this imbalance, and immediately you now have a new higher low. So I will say, for us to create our trend line, we need a low and a higher low in an uptrend. And here you can join your trend line. Here is our new trend line. Here is our new trend line. Okay, lower low, higher low, higher low, and then we are moving in an upside. And looking at this scenario again, you can see the pressure with which price came down and break this trend line, and break, price came with full pressure and break this trend line. So as a conservative trader, whenever price break your trend line, all you need to do is that you wait, because most often it results to a change of direction. So what do? You need to wait for a retest of this trend line. And as you can see, price came back. Here we couldn't get a good candlestick pattern. Price came back, pulled to our trend line, and give us this bearish engulfing candlestick pattern. Bearish engulfing candlestick pattern, which is a retest of our trend line. And after this, you will have your entry here. Your stop loss is always at the previous high, and then you see how it keep on playing out, and it plays out up to this level. So this is how to identify fake out and how you can trade fake out. All right, so we have a three scenario. We have a breakout. In this case, this is a breakout. Okay, price break out of this zone. It no longer respect it as a support and resistance, went back, retest it, and continue to the downside. But in the normal fake out, price will break out of the zone and then return back inside to continue its direction to the right side. I believe you are gaining value from this video, and please do not forget to like, do not forget to share and subscribe to the channel so that you don't get to miss important content whenever we publish them. And the last but not the least, let us look at this scenario that is happening around this zone. If we have our trend line, we'll be connecting these 2 points. So with our trend line, we have this point connected, and all that we are looking for happens in this market scenario. Here we have our lower low, our higher low. We have this higher low